Welcome to Creamer Media's Resources Watch, a weekly video roundup of the events and people making and shaping the news in the mining industry. This week, risk on greater reason for record high Q2 gold price than interest rate decline. Glencore returns $9.3 billion to shareholders, highlights transition metals and recycling. And AngloGold's top-tier Africa assets brought to fore, emissions cut using renewables. The all-time high second quarter gold price is less about the forecast decline in interest rates and more about risk on amid global economy wrestling and world deglobalization.
We saw the average gold price for the last quarter at an all-time high. And it's interesting, a lot of people are suggesting that the gold price is not performing. It's performing extremely well. And for me, the more interesting part is that some see this as driven by a forecast decline in interest rates. And certainly having recently traveled right around the world, I really believe it's more about a risk-on situation as we wrestle with the global economy and deglobalization of the world as a whole, and the fact that China is not, I don't believe, going to get back to where it was. It's certainly going to recover, but not back to where it was. And again, our supply chains and general investment in the economy and upliftment of some of those more challenged economies are going to hurt if we don't stop and invest in it. Otherwise, all we're going to do is create a future where the rich continue to get richer and the poor get even poorer.
In addition to the interim dividend of $2.8 billion, diversified mining company Glencore announced a top-up of $2.2 billion, which lifted this year's total announced shareholders' return to $9.3 billion.
A real solid set of results for the first half of the year. We've achieved an adjusted EBITDA for the year of $9.4 billion, $7.4 billion of that coming out of our industrial asset business. And on the marketing side, a adjusted marketing EBIT of $1.8 billion. As we've said, that's annualizing above the top end of our range. We normally guide a range of $2.2 to $3.2 billion for the year. We've guided that we would exceed the top end of our range and guided between $3.5 and $4 billion for the full year. So we're nicely on track to meet that guidance for the full year, and a very solid and strong set of results on the marketing side of $1.8 billion. The business remains highly cash generative, and during the first half of the year, the cash generated by operating activities was just short of $8.5 billion, which has allowed us to return additional cash to our shareholders. So today we're announcing a $2.2 billion top-up shareholder return. That's broken up between $1 billion in cash dividends and $1.2 billion in share buyback.
4 out of the 5 top-tier gold mining assets of AngloGold Ashanti are in Africa. As the cornerstones of the company, these Tier 1 mines are in Tanzania, in Ghana, and in the Democratic Republic of Congo.
I will spend some time on this slide. And this is the reassessing, let's say, of the portfolio. And you will see we subdivided into Tier 1 assets, Tier 2 assets, and other. Starting with the Tier 1 that are self-explanatory, but you can see 1.7 million ounces of production a year at total cash cost of $940, all-in sustaining of $1,200. So that would situate you along the, let's say, first quartile of big assets in the world in all metrics. It accounts for 80% of the EBITDA of AngloGold and 75% of the mineral resource. So long life and very competitive assets. Let me go over each one quickly. So Geita is performing well. We did have an issue in the first quarter, just a scheduled maintenance, but we expect to make it up. So if you look at H2 production, we expect to be roughly repeating what we did last year. Last year in H2, we did around 300. We'll do probably a little bit less than that, but it will skew hence in Geita to a 40-60 production. We've done it before, we will do it again. That will have important impact in lowering our cash costs and keeping our cash cost guidance, as I'll talk about it later. Obuasi, that will also have like a 40-60 split, probably a bit even more skewed. We did about 120,000, and we are saying, and we're planning to do 180,000 in the second half. Last year we did 160, but last year we were at that time being able to hoist about 4,000 tons per day from the mine up, let's say up from the underground. Right now we're up to 6,000 tons per day with much more flexibility. So the team on the ground and we all, the corporate team, are confident that we'll be there or thereabouts in Obuasi. What does that do to cash costs again? If you take the first half and compare it to the second half, just by the sheer size of production, and the fact that about half of the costs are fixed, half of the costs are variable, that would decrease cash costs in Obuasi by a significant amount in nominal terms and real terms, by about $160. If you take then Kibali seeks to repeat what it did last year of 180,000 ounces. So again, better production H2 to H1. Iduapriem, we also expect about 14,000 higher, and Tropicana similarly. So that completes the tier 1 assets that are the cornerstone of the company in the very near future.
For mining news as it breaks, stay logged on to miningweekly.com and register for our free daily newsletter.